Well, hey there, everyone. Welcome to Chart This with Dave Keller. Happy Monday, first trading day of June here on Monday, June 2nd. I'm your host, Dave Keller, coming to you from an absolutely beautiful, sunny, and nice and comfortable Redmond, Washington. Hope you guys are all doing well. Had a good weekend. Hope you had the same. Nice upside follow through after an initial sell off coming out of the open today. The markets bottomed out around 10 a.m. Eastern time. For the rest of the day, especially in the afternoon, that late afternoon surge pushed the S&P and really pushed the Dow, which is the one that was lagging through the course of the day, slightly below Friday's close. So all the three major U.S. equity indexes finishing higher. Real story, I would argue, though, is in the commodity space. Steel companies higher, which is more materials. But when you look at the commodity space, look at energy, look at gold and precious metals, pushing to new highs and accelerating their previous upswings. Crude oil starting to have a bit of a bounce here, and energy stocks at the top of the leaderboard. So a lot of charts to kind of dig into. The breadth is not as good as you probably would want, given the fact that the market finished in the green. Breadth still weak, and I have a great chart to show you the relationship between the larger companies and the smaller companies, and I'll give you an easy hint. It's large over small. That's been the story for quite some time, continuing through today. Let's get to the charts. So we'll start with the market recap. We'll go to looking at the heat map of how things moved today. We'll go to some of the charts, and then we'll finish off taking a couple questions from the crew tuning in live. Thanks so much for those of you tuning in live on Facebook, LinkedIn, YouTube, and X. Pop questions in the whole time as we go. At the end, I'll take a question or two. Anything we don't get to, we'll put in the mailbag. We had a great mailbag episode on Friday, 6 questions, I want to say. But a lot of fun to dig into those in a little more detail and answer some of the questions that we received during the week. Let's get to it. So looking at the S&P here, and the S&P pushed above Friday's close, which is just about 59.10. That happened in the afternoon, right? So lower open. You can see the open first 30 minutes, we'll call it, pretty uncomfortable. And it certainly looked like we're going to have a fairly rough session here in the first 30 minutes. From there, though, really started to improve. We had some buyers come in around 10 a.m. and then the rest of the trading day relatively strong. You can see the surge right around 2 p.m. Eastern on the Dow, the S&P, and the NASDAQ, really propelling those last two indexes to the strongest points here. So the NASDAQ finished about 0.2% higher. S&P was up 0.4%, finished today just below 59.36. The Dow above 42,300, and that was basically regaining the losses from the morning, getting back up to Friday's close. Mid caps and small caps both negative, as I mentioned. I've got a chart a little later in the show looking at the relative performance of small stocks versus large stocks, or smaller versus larger. Got a couple different ways to look at that, but however you make that comparison, it's definitely not been favoring small caps, and today is just another example of that being a general theme here. Stocks like Meta are the ones breaking out. Stocks like NVIDIA and others we'll share with you. Others not so much, particularly the smaller that you get in the S&P and certainly in mid and small cap indexes. The VIX slightly lower. It actually earlier in the day pushed right up to 20. I want to feel like, how often have we mentioned on the show the VIX of 20 as being an important level? I mean, literally to the tick. We got to around 20 right at 10 a.m. Eastern. That ended up being the lows of the day, and the market rallied from there. I don't want to say that was the ultimate signal, but certainly was a great reminder that level of 20 is usually an important one to monitor. So basically, we snatched victory from the jaws of defeat and ended up strengthening through the course of the day. The VIX drifting back lower, almost getting down to an 18, almost a 17 handle by the close, finishing just above 18. So we're still in a low volatility environment once all was said and done. Looking elsewhere, we can see bonds continuing to deteriorate. The TLT was down 1% here. Rates moving a little bit higher, around 4.46 on the 10-year yield. The long bond yield didn't quite finish above 5%, sort of ended the day right around there. So we're just slightly below there going into or at the end of Monday's session. So bond prices lower, rates higher, the dollar weaker, and so that has been a certainly a theme we've been talking about in 2025. That change from a strong dollar environment to a weak dollar environment. Literally, when you flip the calendar from 2024 to 2025, the dollar started to weaken I mean, President Trump did not make a secret of looking for a weaker dollar environment. I mean, he kind of made comments along those lines, and what he's been doing is certainly not hurt that trend to play out here in 2025. I mean, to be honest with you, you can draw a lot of conclusions about what the dollar strength or weakness could mean. And I had some questions from my market misbehavior premium members earlier today about the dollar strength or weakness versus bonds and other things. And I guess the way I would think about here, it's about confidence, right? I mean, the strength in the dollar means investors are putting money in dollars for some purpose. And if the dollar is getting weaker, probably means they're getting, they're not doing that. And so I think the trend in the dollar, certainly the interest rate environment sort of tells you about expectations for the stability of the U.S. economy and the government's ability to function effectively and efficiently. That is not the vibe I've gotten in 2025, and the dollar is sort of reflecting that weaning or waning confidence in the U.S. financial system. Still in pretty good shape, arguably, but definitely a change is what we've seen on the charts. All right. When we look at the commodity space, the DBC was up just over 2%. Gold and silver having very strong days. The SLV was up over 5% today. Natural gas up over 7%. That's using the UNG. Crude oil prices higher. So the almost entire commodity complex pushed to the upside. The charts of gold and silver we've been tracking for a while. And I grabbed the chart of the GLD, also gold stocks, because gold stocks have been outperforming gold in 2025. So I think gold GLD has been a good chart. The gold stocks have actually outperformed so far year to date. We'll look at a couple of those charts here later in the show. All right, finishing off cryptocurrencies, I guess less strong, right? I mean, compared to the rally that you've seen in equities, they did rally during the equity trading session, but Bitcoin generally drifting lower. We reached an all-time high just above 110,000 last week. Now we're down around 105,000, so still not too far off of those highs, but certainly coming off of that level. Kind of mixed result for the top 10 coins tracked here on the stock charts platform. All right, looking at the 11 S&P sectors, you can see almost all of them finished in the green today, with energy at the top of the leaderboard. That has not happened very frequently here in recent weeks and recent months. The XLE was up 1.3%, then technology number 2 up 0.9%, materials up 0.6%. I mentioned the news with steel companies. That was tariffs over the weekend. And basically increasing tariffs, which should be good for U.S. based steel companies, and the charts reflecting that. Now, honestly, the charts of steel producers, with some exceptions, but generally like STLD, I think is the one that I grabbed. I forget if I grabbed that or Nucor, one of those. But I mean, not great charts, and so you've got a pretty good bounce today. But let's keep that in proper context. Overall, those charts are pretty rough compared to most other areas of the equity markets right about now. On the downside, you can see industrials finished slightly lower, financials, consumer staples, and healthcare just slightly above Friday's close. All right, looking at the breadth conditions here, we can see that decliners outnumbered advancers for most of the indexes, except for the NASDAQ. The NASDAQ actually, advancers slightly edged out decliners, but you can see on the New York Stock Exchange about a 10%, 9 to 10% gap between stocks down versus stocks up. The breadth got really bad in the smaller areas of the market. So again, we're starting the week with another reminder that the smaller companies that you would assume would do well in a kind of classic bull market environment have just not outperformed. It's been a while since small caps have outperformed the way that they traditionally have in bull market phases. The sort of 2024 bull market, I think, was notable in that small caps underperformed for a lot of that period. And it was just when the mega cap stocks, when the large cap kind of AI chip and technology trade is leading things higher, that's just not the environment that small caps are going to do particularly well. Small caps are going to do well when other areas of the market start to dominate, right? Value sectors like financials and industrials and materials, that would tend to be better for small cap stocks. Not today. 2 to 1 ratio of stocks down versus up in the S&P 600 small cap index. Our market trend model remains bullish on all time frames for the S&P. Was talking with our premium members over the weekend on that, and basically what that means for me is to be risk on, to be looking for new opportunities, to be holding stocks as long as they're in primary uptrends. And again, I'm not struggling to find stocks that are looking pretty decent. I don't know if you caught, hopefully you saw somewhere that Grayson Rose and I did our top 10 charts to watch for June 2025. We recorded that last Friday in the Stock Chart Studio here in Redmond. And it wasn't hard to find constructive charts right about now. That is totally fair. What's interesting is 3 out of the 10 charts we shared were short ideas. That's the most we've ever had. So I don't know what sort of a signal that is, but take a look. So again, S&P, the Nasdaq, based on our systematic analysis of the trends, remains pretty constructive here. All right, looking at the Magnificent Seven, Meta, strong update, 3.6% to the upside, arguably clearing that congestion area that we've noted on so many of the leading growth charts here recently. Broadcom up 2.7%, NVIDIA up 1.7%. That's after earnings last week. Only 2 of the names in this basket of leading growth names were down. Alphabet down 1.6%. That's a notable one because trying to hold the 200-day moving average and get above there and stay above there, hasn't been able to do that. Tesla arguably breaking down a bit, down another 1.1% today. All right, shall we look at the market carpet? This is a heat map style visualization on stock charts. A number of platforms have a heat map type of visualization, and I'm a huge fan of that because it allows you to go macro to micro all in one visualization. Take the overall landscape, get into specific themes and stocks, kind of everything in between. So this, I don't know what your impression is. If you've been watching the show for a while, we always kind of take a look and just take a deep breath and see what it looks like. It's a very mixed day, right? I mean, as much as the indexes finished higher, this is not great breadth. We saw the breadth readings were more negative than positive, and that's really more what this looks like. And I'm drawn particularly to the general negative move that you had in industrials today. Industrials have been, undoubtedly one of the top sectors in 2025, maybe one of the most consistent outperformers in 2025. Defense stocks have been a big part of that story. Stocks like HWM making new all-time highs again today. So those names are there. But a lot of things actually that had been trying to improve started rotating lower. And it's a lot of these sort of, I don't want to say junky industrials names, but these are the names that have not been doing particularly well. Names like Masco that rallied out of the April low. Masco really, rallied in early May, kind of giving back some of those early May gains and going back on the negative move. UNP and other railroads. Let's take a look at UNP as an example. This is how the market's feeling like it's evolved here, right? This coming out of the early April low to mid-May. Obviously the leading sectors, technology, industrials, consumer discretionary, 3 top sectors over the last month. But then from mid-May to the end of May, beginning of June, look at how Union Pacific, which gapped higher in early May, pretty sure that gap right there is when the tariff sort of unwind happened, right? Sort of, or delayed, right? Right. We're not going to have these aggressive tariff. The finish line is pushed down a bit. And the market had a nice gap higher, but from there, UNP sort of rotated lower. So you had sort of that initial bullish reaction on a lot of these charts, particularly in the industrial sector. And then from there, just kind of dribbling lower, right? And again, this is as Meta and other, leading technology-oriented names had pushed higher, but then had sort of stalled out, right? The S&P and the Nasdaq sort of in that sideways congestion area. So railroads is an example of a group actually struggling, kind of pulling back through that period. And what that tells me is it would certainly be a much more bullish environment if the breadth improved. If charts like that started to resume their uptrend, it certainly would feel much more like a classic kind of bull market phase where you have markets going higher on stronger breadth readings, which means it's not a narrow advance but a broad advance. And I'm not really getting that vibe on today's session at least. Noting within communication services, sort of one up, one down. Alphabet down 1.6%. This is as Alphabet has just pushed above 170, which was the swing high from late March. Question is whether it can get above the 200-day moving average and hold it. Today, kind of giving some of that back. Meta, on the other hand, powering above 650, 660, and pushing a little bit higher. I did grab the chart of Meta so we could look at that in a little more details here. But I think that's one to pay attention to for sure. Semiconductors, a huge story last week, going through NVIDIA's earnings, going through the end of the week. Question is when we get into this week, whether you see further upside. I mean, charts like AMD kind of waiting to see if they resume the uptrend, kind of not quite, but having a decent update. Micron was up about 4% today. Would love to see if it can get above 100. AMD, one of the big players, obviously in semiconductors, pulled back from that early March high, May high, that is. And we'll see if it's able to improve it. But NVIDIA having a nice follow through so far after earnings. Broadcom making a new high today and an impressive recovery, 100% recovery back to the December 2024 high, which is a pretty impressive rotation. Elsewhere, strength and energy, of course, kind of the story, part of the story as well. The XLE is not my favorite chart. I think that's pretty clear for using classical technical approaches. There's a lot of charts like Apache that still look like they're in a pretty good downtrend over the last 12 months. But a lot of that has been, I think in no small part because of weakness in crude oil prices. They actually pushed higher pretty good today. So if that's the beginning of further upside in crude oil, certainly could see some upside there. I'm thinking of my interview recently. Who was I talking with oil about? Boom. Oh, it'll come to me at some point. Jesse Felder. We were talking for editor of the Felder Report. We talked about a long-term chart. It was like a weekly or a monthly chart of the XOP, I want to say, talking about a potential breakout there. Again, he was pretty bullish on it. And pipelines, charts like Williams looking pretty good. It's sort of the integrateds and others, the producers that don't look as strong. But again, that's because crude oil prices have remained relatively low. We'll keep an eye there. In the materials sector, I mean, kind of a mixed day, but look at some of the names like Newmont, one of the gold stocks, trying to make a new high for the year. FCX threatening the $40 level, and then the steel makers like Steel Dynamics and Nucor. And again, they're not great charts yet. Maybe they're less bad charts, but I think still more to prove along those lines. All right, we're going to get to some charts here to continue. I do want to remind you, though, I promised George Noble that I would remind people about his independent research conference that's coming up this Thursday, June 5th. I keep threatening to put a link to allow people to sign up, but I think I've forgotten until this moment, but I will do it today. Noble-capevents.com, noble-capevents.com. Use code SAVE100 for $100 off the registration. He's featuring, basically the people in George's Rolodex who are fantastic independent research strategists. People like Jay Pulaski, who started the asset allocation team at Morgan Stanley in the early 90s, now running his own independent research shop. Michael Howell of Cross Border Capital, formerly at some big shops in London. John Roque, who I've interviewed and have known for a number of years at 22V Research, which is made up of a group of ISI economists and strategists. It's a really good lineup. George is a fascinating person. We'll have George on our podcast in a couple weeks. Excited to sit down with him virtually and talk about all things. But you can sign up his events coming up all day this coming Thursday, June 5th, and we'll put a link in the description to sign up if you're interested. All right, let's continue on looking at the charts. The S&P daily chart. I mean, honestly, we sort of continue to sit in this range, right, between 5750 and 5950, 6,000. As I mentioned, we're in a green light area. I'm thinking of this like a stoplight. Anything above 5750 is a green light. That means I'm pretty happy owning stocks, particularly strong charts, and assuming that this trend is bullish until proven otherwise. Between 5750 and 5500, I'd probably be taking bets off and thinking more neutral positioning. Anything below 5500, I'd probably get pretty bearish pretty quickly. And then again, I think anything above that point, above that 5750, 5800, is just chop for now. Now, Meta is one of those stocks, having this kind of similar pattern, but then finally breaking above there. And I think that's what you would need to see, right? It can't just be Meta. It's got to be a bunch of other things. Meta is kind of the outlier at having exited this consolidation phase. Others have been trying to do it. And I think you need more and more of that. And again, a meaningful upside beyond what we've seen so far off the April lows, I think most likely has to be driven by broader improvements, which means breadth indicators which have been pulling back. Particularly the short-term breadth indicators have not been as strong recently. We need to see those cycle higher. Today, not going to help with that because the short-term breadth indicators are remaining pretty low given the weakness breadth-wise today. But that's sort of one of the key themes I would be looking for. For now, the S&P and the Nasdaq holding their 200-day moving averages. I think that's noteworthy. Now, we talk a lot about breadth on the show and in my work. It's a big part of how I think about the financial markets, and that really I sort of gravitated toward that more and more over my career. I remember Phil Roth, who was at Miller Tabak back in the day when I was in New York at Bloomberg, and met Phil and heard some presentations that he did. And he talked all about breadth indicators. And I was just completely struck by how it helped him understand sort of the next level lower. And I was super impressed by that, and started looking at some of the techniques he looked at, looked into others that talked a lot about breadth, and just fell in love with that way of helping you understand not just the S&P as an index, but the S&P as a group of 500 stocks, and the Nasdaq as a group of hundreds of names, and just really looking to connect individual stocks with the big indexes and thinking what's happening between there. So the couple different ways we talk about breadth: advanced decline data, the McClellan oscillator, still below zero, by the way, I think after today's close. But we can also look at the relative performance of smaller indexes versus larger indexes. And that's what we're doing here. The top panel that you're seeing is looking at the Russell 2000 ETF versus the S&P 500 ETF. So if that line is going down, small cap stocks are underperforming large cap stocks. And if the line ever goes up, which it does randomly, but for the last couple of years in short little bursts, that means small caps are actually outperforming large caps. The bottom panel, similar concept, but it's looking at the equal weighted S&P 500 versus the cap weighted S&P 500. So here we're looking at, when we're going higher, that means the equal weighted is outperforming the cap weighted. And what that does is the normal SPY is really dominated by the mega cap names, right? Like the 10, 20 biggest stocks have a huge weight. So the S&P's movements is really driven primarily by those mega cap growth stocks. The equal weighted S&P minimizes that impact because all 500-ish companies are treated with an equal weighting. So it really is more of a play on the smaller names because they have more of a voice in the equal weighted S&P. Now you can see both of these have very similar contours, which is why you really don't have to look at both of them a ton, although there are times when they disagree a little bit, which is probably why it still makes sense. But here we're seeing small caps underperforming large caps so far in 2025. That really has been the long-term story here for a number of years. And outperformance of small caps has been pretty rare and for limited periods of time. Year to date, if you were thinking, all right, maybe 2025 is the year of the small cap. And I remember asking people on my podcast, right, in this area, if that was something we might see. And none of the things we talked about needing to see have really materialized. And you've really just continued to see small caps underperform. So that means as an equity investor, there's just not a lot to be gained by looking at small cap exposure until something like that reverts higher and starts to show that we're seeing a bit more of a rotation. On the bottom panel, what this basically means is within the S&P 500, it's been better to stay with the larger names as opposed to the smaller names, which are still kind of mid-cap, small-cap stocks in the S&P 500. So both of these making new 3-month lows, in the last month or two. Both of them clearly trending lower below their 50-day moving averages. There's going to be a time when the dominance of mega caps is not the story, and the story is more about identifying opportunities further down in the cap tiers, as we would call it. These charts tell you that day is not today. All right, let's talk about what else is going on. The dollar continues to weaken. Now, the dollar weakened through, really from the beginning of the year. It went higher for about a week, and then that was it. Started to rotate lower. It bottomed out a little bit after the equity markets bottomed out. Equities bottomed here on April 7th. It took about 2 more weeks for the dollar to bottom out. And then you had this nice counter trend rally into early May. From there, though, it's rotating lower yet again. And as I mentioned earlier, a number of reasons you can kind of cite. I mean, it's hard to always know exactly what a stronger or weaker dollar means. And anyone that tells you this is absolutely what it is, trust me when I tell you there's a lot of guesswork that goes into it, because there are a lot of things that impact the value of the dollar and a lot of things that could happen because of a stronger or weaker dollar. Those are all assumptions and things we're modeling based on what's happened historically. But I would say, based on where we're at in the cycle and based on what the equity markets have been doing and risk assets, I would say a weaker dollar here, probably just suggests that you have less optimism or less confidence in the U.S. debt. The Moody's downgrade is part of this sort of rotation here. Sort of the last rating agency to take the U.S. out of that highest rating, sort of rotating lower. Treasury auctions have not been going particularly well, and as a result, you're seeing the dollar kind of weaken. So, times when you would normally get a stronger dollar, particularly when people are going a little more risk averse, we're not necessarily seeing that. And I think a concern there is that, you could argue that some of the best bull markets, recent bull markets, have been driven in a lot of ways by foreign investment in U.S. assets, and so you really would hope that would resume, right? And that's what could really propel the equity markets to further gains. So keep an eye on the chart of the dollar. Crude oil, gold, both going higher today. Crude oil gapped higher. This is the crude oil future that we're looking at. I think this above $65 a barrel all of a sudden becomes a really compelling chart, because what that would mean is that would confirm that this was a double bottom from a technical perspective. Breaking above that interim swing high around 65 would complete that upside rotation, probably suggest further upside to be had. And energy stocks have not generally been great, but I think crude oil starts pushing above $65 a barrel and continuing upwards. That all of a sudden provides a great tailwind for energy stocks. Gold has been in a, what we call a bull flag pattern here. I would argue that bull flag now confirmed with the action we saw last week, and now into today's session, breaking above the trend line using the swing highs from April and early May. So gold and gold-related things all kind of moving to the upside today. Here's the chart of the GLD. We can see in a good uptrend from the beginning of the year through mid-April. We then have this bull flag pattern of lower highs and lower lows. We highlighted this chart, I think, on Thursday's episode last week. You can see today the GLD gapping above that trend line resistance. The RSI on this bull flag pattern remained pretty constructive, not getting anywhere near 40. And so that sort of implies we're still in a bullish phase, as we had a successful test of the 50-day moving average. And I do own the GLD and the IAU in my own accounts. I don't own the GEDX. I kind of wish I did, because the chart actually is performing even better than the GLD in 2025. And the bottom panel will show you that. But just to reiterate, on a price basis, right, gold and gold stocks look very, very similar here generally. Now, if you look at like Newmont versus Anglo Gold versus a number of others, you'll see some differentiation between those individual names. But as a basket of gold miners, which the GDX is a good example of, we can see an uptrend and then this pullback, what we call a flag pattern. That flag pattern confirmed last week. Now, the bottom panel is showing you the relative performance of the GDX versus the GLD. So the GDX is an ETF holding gold stocks. The GLD is an ETF holding physical gold. So when this ratio is going up, that means gold stocks are outperforming physical gold. When the line's going down, that means gold stocks are underperforming physical gold. We can see in the fourth quarter of last year, the gold stocks underperforming physical gold is during this pullback. But we can see that in 2025, pretty much from the beginning, with some noise along the way, generally gold stocks have been outperforming, and that's really accelerated as both tested their 50-day moving average and now have pushed higher. All right, let's look at some other stocks here to finish off, and then we'll take a question or two. We'll be good. NVIDIA, earnings overall were pretty blowout positive. Now, what's interesting is the reaction post-earnings was not as great as you probably would want if you're all bulled up on NVIDIA. I mean, a decent report, arguably a very good report, Wednesday after the close. Thursday, we gapped higher, closed lower. Friday, we closed lower again. Today, kind of filled about half of that candle. So that's called... it's called a bullish inside day. If you're talking about bar charts, called a bullish harami pattern, Harami. Not as common. It's kind of the opposite of a bullish engulfing pattern. It's also bullish, but it's a two candle pattern. We have a down candle and an up candle. Day two's range is smaller than day one's range, so the body fits into the first one. Called a bullish harami pattern. It's a short-term reversal pattern. It tells you the next 1 to 3 bars. More likely higher than lower. I think the chart of NVIDIA is a great chart as long as we hold this trend line support. We've broken through the 200-day. Again, I mean, it would have been much better had there been a much further upside move post earnings, but I mean, generally still in a primary uptrend. Hold the trend line, hold the 200-day. There's a lot to like there. What's not to like? The bearish momentum divergence. That's the one kind of red flag on charts like NVIDIA that I'm certainly keenly watching. Meta did not have a bearish divergence, but hit a peak around 660. This is after bouncing in late April off of 480, hit 660, pulls back a bit, and then last week sort of chopping around, and then today we're resuming the uptrend, making a new 3-month high, which is what puts it on a regular screen that I look at. Holding the 660 level tomorrow, I think would validate that breakout. Meta's a really good chart. I mean, arguably joins Netflix as the two strongest charts within that basket of magnificent 7 names. Costco is a name that we highlight, and actually, I think this was one of the 10 names that I included in the top 10 charts to watch that we recorded for Stock Charts TV last Friday. I'll include a link to that one as well. I'm going to write these things down. It's what the problem I have is I say I'm going to include a link, and if I don't write it down, it actually doesn't happen. My family loves to make fun of the fact that that is 100% how my brain is wired. So I'm doing it right now. Include link to Stock Charts, top charts. I'll remember now. So Costco, breaking above this resistance area. And again, this pullback's around 875, 880. Double bottom pattern, pushed back above the 200-day, cleared the 50-day. Now we're just making these new higher highs and higher lows. And Friday, nice follow through to the upside. And then today pushing higher. Now, decent overhead resistance at the February peak around 1075, but I mean, this is a strong chart. And this is the type of chart I'd be pretty happy owning. I don't own it, but if I did, I wouldn't be disappointed with that probably. Cleveland Cliffs, I just wanted to share with you. I mean, this is a stock up 23% today. Steel company, Nucor, Steel Dynamics. I thought I grabbed Steel Dynamics. I think I grabbed CLF instead. Just a reminder that when you see names like this up a ton because of a tariff announcement, for example, it's good. It's not bad. And could Cleveland Cliffs go a lot further from here? It could, but is this really a good chart yet? And I would argue 100% not, right? We've had one gap. I mean, Friday, we're making a new 52-week low, a new multi-year low. Today, we capped higher. The problem is the stock is such a low price that this little move here, still below downward sloping moving averages, is enough to register a 23% gain in one day. For me, I would much prefer waiting for validation, waiting for a sign of accumulation, which means we need to at least break above the 50-day moving average, start to see improvement in things like momentum and relative performance. It's a one-day move. Keep an eye on the space. And certainly if the tariff announcements hold, it's not going to be a bad thing. It's going to be a tailwind. But these are stocks that have been struggling for an extended period of time. Finally, Robinhood Markets, Hood, making a new 52-week high, indeed a new all-time high today. I think that's worth highlighting. Pushing close today right around 68, and that's up 3% today. The relative performance making a new high, the price making a new high. Think what you want about Robinhood, and again, potential double top. But if we can clear it, pretty strong upside potential. Nothing to the left on the chart above that previous peak. So again, I learned a long time ago, don't be afraid of the new highs list. Think of that as stocks that are demonstrating optimism, or where investors are demonstrating optimism. Those are often some of the best ideas we can identify. All right. Can we take some questions? Let's see. Kamran, thank you for asking about this. I've gotten questions along these lines for a answer. And just to be clear, no, I don't use WhatsApp for anything like that. Wouldn't do it. I'm familiar with the fact that there are scams, and unfortunately for other financial content creators, this is pretty common these days. Unfortunately, this is the dark side about WhatsApp and putting content out there. So that's definitely not me. Please don't do anything with it. Anything that I do is on my website, marketmisbehavior.com. So if you want to know if something that is actually me, look there. Otherwise, apologies. I wish there's something I could do. I've done everything that I think I'm in, and there's not much I can do, unfortunately, except just tell people, nope, that's definitely not me. And I hope you do your due diligence to confirm that it is not me. I've talked with others that do a lot with financial media and on social media, and 100% of us have had that particular experience. All right. Let's see. What else can we do? Well, I like this comment here, so I'm gonna put it on. I'm gonna put it on. Where was it? I mean, yeah, plenty of comments on Trump and the taco trade. Um, I'll save my judgment on that one. XLI, David, thanks for watching on YouTube. XLI looked good today. Hammer pattern with a low testing the 20, which was bought less than 1% from all time highs. So industrials have been, one of our kind of, key ideas here. We've been talking a lot about industrials. Really started with the defense stocks looking so good. And that was one of the initial kind of winners in 2025, right? As we sort of hashed out all the things that happened in a flurry of news headlines. Pretty clear that defense stocks and aerospace stocks are probably going to come out of all of this in pretty good shape. And I think that's pretty much what's happened here. I don't know if you were talking about the 20-day moving average. The reason why I wanted to highlight your question, when I did the special with Grayson Rose on Friday, we talked about looking at moving averages. Yeah, here's the 21-day exponential moving average. 20-day is what it is. I meant the 21-day, but pretty much the same. We were talking about this combination of three moving averages: the 21-day exponential moving average, the 50-day simple moving average, the 20-day simple moving average. And I forget what chart we were looking at, but particularly in accelerated uptrends, you'll often find something holding the 20-day or the 21-day moving average as a short-term kind of tactical level of support. And I think it's interesting that industrials pushed above that level in mid-April and kind of remained above there, even with this last little period of chop. And I think what's important, and I ask most guests that I can bring on my podcast, how do you separate the short-term noise, right, normal kind of market fluctuation or response to some headline versus a larger structural change? And I think things like moving averages and seeing if they hold can be one of those ways to at least try and validate whether what we're seeing is just normal noise or something more significant. Average true range is another way that you can do that, which is why so many people use that as part of a money management strategy. And so I think that's another way to think about it as well. Trying to separate, what they call the signal from the noise, I think is a good point. All right, one more. Casey, thanks for watching on YouTube. Comments on UNH. A couple of people actually asked about UNH during the show. I mean, listen, this is not, it's just not a good chart yet. And I will tell you the challenge you're going to have if you look at a chart like this and think, wow, this is a really good entry point. You and I are probably not going to agree on that, only because in my general opinion, I'm generally looking for things that are growing, and I'm looking for things that are above upward sloping moving averages. And something like United Healthcare is just not on there yet. It's obviously a very gappy name. We've had some serious news headline risk that has been magnified with these gaps to the downside. If there's something to be encouraged about, it's the fact that this most recent gap is different, right? If you look at this gap, right, look at what happened here, right? We had been going higher, going higher, going higher. Then you have this big gap lower, and then we just continue, right? So after like a day, it's like that feels like a what you'd call a breakaway gap or an impulse gap, right? This is a gap that happens at the beginning of a move. New headline comes out, new information is surfaced. The market completely upgrades or downgrades the stock, and then it just keeps going. And so that's an example of a breakaway gap, a new thing. What happened down here looks more like an exhaustion gap, right? What you're looking for in a big sell-off are what we call signs of capitulation. So let's look particularly at that low. I'm going to change this to a candle chart. I don't look at volume a ton, and I haven't looked at volume on this chart, but I'm going to look at it just because. And let's look at what happened, and maybe we color the volume. All right, that's good enough. And let's look at like the last 6 months. So here's what happened, right? So you have these gaps here, right? There's that impulse gap, and then we drift higher. We had another gap, but we drifted lower. Then we have this gap here, and I think this one's a telling one. Tons of volume, hammer candle, gap lower, and then we immediately bounce higher. So those are some of the conditions that would suggest what's called an exhaustion gap, right? Those are the things that happen at the end of a move as you're trending lower, then you have a big gap down, heavy volume at the lows, and some sort of bullish candle pattern that tells you people are accumulating the stock. So what happened is we gap down at the open. We traded all the way down to this point, but by the close, we're all the way back or above 270. And from there, we've kind of pulled up. So I would say, I mean, I'm not a big fan of buying weaker charts, but if I was more of a contrarian, this is a chart I'd probably take a look at. And the reason is because the risk reward is pretty clearly defined, right? And what I mean is you've kind of defined the floor in the market because this is where the big puking out of shares happened. The accumulation happened because we saw the hammer candle and we haven't touched that level again. So there's your sort of theoretical downside. There's your risk. But then you've got the upside to, maybe if we just get back to the 50-day moving average, that's a big, upside reward for clearly defined risk. So I would probably, if I was more how I was trading, I get the argument for it. And I like this, what we'd call a sign of capitulation, the gap, the bullish candle, the heavy volume. That's what a lot of times what a major low would look like. I don't trade a lot in that particular sort of mindset, but if you do, I would do that. And as a tactical stop, right? If you take a position like today, for example, as an initial stop, right, we would call like take half of it off would be maybe at the swing low here, right? You're betting on this being a higher low, and you're betting on a resumption of a new uptrend, which means you take some of it off there, and you'd unwind completely if we don't hold that gap level from mid-May. That's how I would structure a trade using the best practices of candlestick analysis and other technical disciplines. There we go. A little deeper into the chart of UNH I wanted to go. It ended up being a really interesting example. I appreciate all these thoughtful questions. Don't have time to get to all of these, but some really interesting ones I'll try to pop in the mailbag and hit on Friday's show. But for now, I will say thanks so much for joining me here today on Monday. I appreciate all your thoughtful questions and making this an entertaining way to spend the day after the close. And please remember, it's always a good time to own good charts. Have a good night, folks.